I'd like to get started. My name's Ram Shenoy. I'm the president of the Houston chapter of TiE, and we're very pleased to welcome this evening Alberto Gomez Obregon, who will introduce himself. We'll ask him to introduce himself in a minute. Before I get started, I'd like to thank everyone joining and just say a few words if you're not familiar about TiE. TiE, the Indus Entrepreneurs, is the largest nonprofit devoted to fostering an entrepreneurship. We run programs around mentoring, education, angel investing, networking, all sorts of activities dedicated to help encourage entrepreneurs to succeed in their endeavors. And a recent theme of ours has been impact investing. And the purpose of this webinar is to conclude a series of talks and sessions we've been having on impact investing. And for that purpose, we're very pleased to welcome Alberto, who's very experienced in this area, to give us his perspective. Before I ask him to introduce himself, I'd like to acknowledge our corporate sponsors and our charter members, without whose subscription dues they always help to underwrite the activities we run. So with that, the format of this hour is that Alberto will first take 3 to 5 minutes to say a few words about himself. And then we have about 25 minutes of prepared Q&A where he will describe his activities and his firm. And during that time, I'd encourage those of you in the audience to submit any questions you have using the webinar chat function. I'll endeavor to do my best to feed those questions to Alberto while he's speaking, or we'll give the balance of the questions after he concludes his speaking around 30 minutes into the webinar. So with that, Alberto, thank you so much for making the time to speak with us today. Tell us a little bit about yourself first.
Great. Thanks, Ram, for that warm introduction, and thank you all for joining. I'm really pleased to be here to talk a little bit more about impact investing and how this sector is evolving globally. My name is Alberto Gomez Obregon. I am originally from Mexico. I'm an engineer and started a career in traditional finance as an investment banker in the early 2000s, and then moved to private equity, working with pretty large multinational investment firms like the Carlyle Group or Partners Group. Did that for about 10 years. And that moved me over different countries, where I ended up in the US. I currently live in New York. I've been here for 11 years. Arrived in 2012, and over a few years, more than 10 years in the traditional investment space, at some point I decided that I wanted to shift my career to find more purpose in my day-to-day activities, and also to focus more on interventions or organizations that were bringing innovation or creativity to solve problems. And so after a period of time around 2015, 2016, and a lot of personal exploration and journey, I decided to transition away from the traditional private equity landscape into impact investing. So it's been about 8 years that I joined this sector, first as the Deputy Chief Investment Officer for a US organization called Acumen. They have operations all around the world. They have investment activities in the US, Latin America, Africa, and India primarily. I was there for 4 years, and then joined COcapital as a managing partner of the investment vehicle that we have within our organization. And so today, after having made that change, I feel that it was timely, because this sector is definitely growing, and there's just so much more people and activity and funding coming into the impact investment space, which I feel that will continue to grow over time. And ultimately, I believe that impact investing will become the sort of the new normal of investing in a world that is becoming more and more complex, and we're facing issues that might not be reversible. And so with that, I wanted to share some slides on a bit of context on the sector, and then talking a little bit about our organization. We are a certified B Corp that invests across Latin America, and we are what is called an impact-first investment fund, focused on three main pillars: reducing inequality and poverty, promoting gender equality, and/or mitigating climate change. So a bit of history. We started in roughly 2011, 2012 with a nonprofit called COPlataforma. And this nonprofit, what it has been doing over the past 12 years, 10 years, is it behaves as an ecosystem builder. So basically, for an impact investment ecosystem to exist and to function, there needs to be entrepreneurs and investors. But as impact investing is still a nascent sector, in emerging markets, I would say that it's really started to develop over the past 10 years. Maybe in Africa and some points of Asia, it started before, but at least in Latin America, the sector has really taken momentum over the past 10 years. But there wasn't really a lot of pipeline of companies or startups to invest in at that point in time. And so our founder, who started COPlataforma, what she basically identified was that in other parts of the world, in order to have this ecosystem, you have to be doing basically what TiE does. You have to have incubator programs, accelerator programs, mentorships, prizes, grants. So there's a breadth of different interventions that need to be in place to develop a funnel or a pipeline or an ecosystem of entrepreneurs to exist, and then connect those with impact investors. And so COPlataforma, basically the model which it has been doing has been financing organizations that support entrepreneurs to arrive to Latin America. So we have funded or financed organizations like B-Lab, Village Capital, large relevant groups from outside of the US to establish in Latin America and support entrepreneurs. And then in 2017, when we had developed sort of a relevant ecosystem, and we saw that there was now pipeline coming out of the country, that's when the idea of having a fund or an investment vehicle on the side of the nonprofit came to be. And so that's when I was still at Acumen at that point in time, and Tanya, our founder, reached out to me and said, hey, we want to have an investment arm, but we don't really know how to invest with impact, and so we'd love for you to help us develop the thesis, the strategy, and then over a period of time as an advisor and a board member, we developed a thesis. We did a few investments, primarily in education at that point in time, and then in 2019, at the end of 2019, we launched a formal fund and started raising our first investment vehicle, which we now manage about $14 million. So it's a relatively small vehicle, but given the stage of development of where Latin America is, the pipeline that we're seeing, and the size of the companies that come our way, it's sort of the relevant amount to deploy checks that are aligned with sort of what we're seeing as opportunities. And so before moving forward into our firm and giving more details on that, I wanted to kind of step back and talk a little bit more, or give a little bit more context about the impact investment sector, because I know this is a conversation that has been relevant, and there's been questions around sort of the difference between impact investing and other types of asset classes. And so basically, this is sort of at a very macro level, the different types of capital that exist in the world today. On the right side, at the end, far right, you have traditional investing, which typically focuses only on financial returns. And on the left side, you have traditional philanthropy, which is typically only looking for impact and expects no capital in return. And so over time, what has been happening is that there's different ways in which these two types of monies have been moving towards the middle, arriving to what is called impact investing. First, on the traditional investing side, we started with what is ESG investing, which is not specifically developed to focus on solving a specific issue, but rather having companies adhere to certain best practices, environmental, social, or good corporate governance. And then from the philanthropic side, over time, it's been used in different ways, like venture philanthropy or like concessionary capital or even returnable grants that start behaving a little bit more similar to capital in how they're structured, and what type of businesses or organizations they're supporting. In some cases, looking for a return, in other cases, still without the intentionality of a return. But in between comes this new space, which started about, I would say, 30 years ago, which is impact investing, which, if it's not concessionary, because there's a lot of confusion between what is concessionary investment capital and what is traditional impact investing. We are seeking market rate returns. But what I think is important to mention is the market rate return might be different by asset class, but on average, what I have seen at a global level within the impact investment sector, I would say that about 15 to 20% IRRs are what is right now being denominated as market rate returns within the impact investment space. This shifts by sector. When you're investing in climate tech, returns can be much higher, like 30, 35%, more similar to traditional venture capital. When you're investing in social impact, which is when you're focused on poverty issues, especially in sectors like agriculture, which are very complex, returns might be a little bit lower, maybe reaching like a 10%.
Alberto, if I may, just sorry to interrupt, but I just wanted to take the opportunity to feed a question to you from Somesh in the audience, because it's sort of relevant. This slide is immensely helpful, and I think will probably provoke a bunch of questions. Somesh's question is about the focus of your firm, COcapital. Is it exclusively Latin America and Mexico, or do you include aspects of North America, communities in the US? And related to that, when you talk about expected returns, do you expect those returns to vary geographically? So is your expectation in Latin America, is there sort of a country risk premium you're applying there compared to the US or not? Could you speak to both those aspects, please?
Yep, thanks, Ram. So yes, we are primarily focused on Latin America. For now, we do not have direct investment activities outside of Latin America. We do have a vehicle that invests in funds. So it's not investing directly into companies. It's a fund of funds vehicle that we manage for a single family office that is looking for global climate tech and food system funds. So within that mandate, we can invest outside of Latin America, but the direct investments that we're doing are only in Latin America, given that it is the network and the region from the world that where we are from and that we know better. And then in relationship to your second question, most of impact investment capital historically had gone to emerging markets. As I mentioned at the beginning, I would say that Africa and some regions of Asia or some countries in Asia have been the ones that have attracted or had attracted the largest amounts of impact investment capital. And today, the global assets under management for impact investing are slightly above $1 trillion, according to the GIN. And so most of those funds had been directed to Africa or Asia. Over time, and as other spaces like climate tech and food systems have gained more traction, and also as countries like the US have acknowledged that there are also deep inequality and poverty issues in these countries, there's now a trend of impact investment going also into developed markets. But I would say that those average returns that I provided of 15%, maybe 20% IRRs are relatively global. In Acumen, as I mentioned, we managed several for-profit funds that invested across different regions of the world. And the returns were quite similar, or the return expectations of LPs into these funds were quite similar, primarily focusing on that 15% return. Where the shift comes rather than geographic is as I was mentioning, more on sector. So environmental related investments, particularly when there is technology associated to them, so what is called climate tech, or consumer products within the food systems, those tend to have much higher financial returns, more closer to what venture capital looks like. When it's related to social issues, where you're dealing with poverty, education, agriculture, healthcare, and they're not tech-enabled business, returns tend to be between 5 and 10%. And then when there's technology-related issues, they tend to be maybe like at a 15, 20%. So it really depends on the strategy of each fund, if they're investing in tech-enabled businesses or not, if they're investing in real economy businesses, if they're only investing on social issues or on environmental issues. But you can play with returns. And the way in which we think about returns is, and I'll touch on this, and I have some slides in the next, I have some slides coming up where I map sort of impact versus returns. We construct our portfolio based on different profiles of impact, but also different profiles of return, looking for an average return of 15%. But there are companies in our portfolio which we're targeting to have more than 30% return, and others which may have like a 10% return. But we're going to look for an average to provide our LPs with that sort of midpoint 15% IRR.
Thank you.
And so I'm going to go quickly through this slide, but basically what I was alluding to at the beginning is there's 3 main pillars of impact that we're working on. One is reduction of inequality and poverty. The second is gender equality, and the third one is climate change mitigation. There's a lot of data that states and now confirms that there is the possibility of investing in for-profit companies that have sustainable, scalable, and financially attractive business models within these 3 pillars. Climate change being the one with the highest potential returns, and sort of reduction of inequality and poverty being the one with the possibly the lower financial returns. How we think about companies, we're a venture capital fund. I mean, that's sort of, if you compare us to an investment firm, we operate very similar to a venture capital fund. The type of due diligence that we do, how we source companies, the stage at which we're investing in, how these companies are structured, it operates very similarly, but we have this additional criteria, which is impact. And so based on that, there is, through this additional criteria, there's just a bigger amount of data and a more, in some cases, complex decision that we need to make, which is, can a specific company that is looking to solve a social or environmental issue sustainably, scalably, and profitably create a business model that will, over time, still be focused on solving that issue, while at the same time providing a financial return for its shareholders. And so the most important thing for us when we start an analysis on a company is there a mission and a real impact thesis behind the business model, and how committed is that team to that impact and that mission. We also obviously look for sort of the hard skills of the team and the management, but they have to be aligned with impact and the mission that the organization has developed for itself. And then the other two criteria that we focus on are profitability and scale, primarily tending towards companies that do look for to reach break even in profitability over a short period of time. We are a more conservative investor, and we don't invest in sort of ultra high tech companies with extremely crazy burn rates. So we want companies that are more sort of real economy, even though they have some level of technology within them, but are going to reach some sort of stability and profitability soon. Because our portfolio construction model, as opposed to some other VC funds, is we're not investing in 40, 50 companies and hope that maybe 5 are successful in return, 5 times the fund. We basically want every single one of our investments to be successful. And so we're very diligent on choosing each of them, because each one is causing an impact that we believe is relevant, and we don't want that company to fail. These are the 4 main sectors or themes that we invest across: education, workforce, and economic development, access to healthcare, access to basic infrastructure, and agriculture, food, and ecosystems regeneration. And so the idea is that we're going to build a portfolio relatively balanced across these 4 themes. We're looking to invest in 10 to 12 companies. We've already invested in 5. And we're like halfway in our investment period. So the idea is to continue to invest this across these 4 themes. And I know that there was some questions in the previous conversation about how we decide and how we choose companies. And these 2 pyramids that I'm going to present to you are related to sort of how we think about impact, but also how we think about financial returns. So basically, at the bottom end of the pyramid, you have, and this is social enterprises or companies that are working on social issues only, not environmental issues. So how we think about impact is there's basically 3 levels of social impact. The first and lowest level of social impact is you're improving the quality of life of poor people. That means that they maybe have access to electricity now, or maybe they have access to a stove in their house that is powered by gas and not cooking with coal or wood. And so improving their quality of life is important, but that does not get these individuals out of poverty. It just betters their life. The second one is investing in organizations that are looking to increase their income and the stability of that income. And so these companies tend to, one, be in either education, so that they have the possibility of increase their income over time, or are working as intermediaries in supply chains, the agriculture, artisan space, etc., where you eliminate intermediaries, you work with producers to provide higher value products and pass along more margin from the supply chain to them by all the different activities that you're doing. And then the third and deepest level of impact is companies that over time allow for individuals to have ownership of productive assets. We believe that the third one is the only way that people can come out of poverty. Even if you increase your income, if you lose your job over time, you might sink back into poverty. So increasing and stabilizing income is important, but it's not the deepest level of impact that you can have from a social perspective. So obviously the upper end of the pyramid is the lower return spectrum, and the lower end of the pyramid is the higher financial return spectrum. And I think you have a question, Ram.
Yeah, Alberto, perhaps I could ask you, just from my background in oil and gas, test out an example with you to see how you might evaluate it as an opportunity within your firm. So the example is Latin American oil and gas company, which is interested in generating carbon offsets for its operations. So it's looking at nature-based solutions, perhaps buying agricultural land to implement some sort of soil carbon capture. So the idea is avoid deforestation, buy land explicitly to preserve it, to capture carbon, measure it, and create a business by selling those carbon offsets perhaps to offset your own carbon generation, or perhaps to sell it to others. That would, on the surface, fall within your climate change remit, but it has a lot of different types of risks associated with it, although it might have an impact on local economy. Is that the sort of thing that would fall within something you would evaluate, or would be too far afield?
No, that's totally. So actually, we have seen several companies that are buying land and regenerating ecosystems to create carbon sequestration sinks and generate carbon credits or carbon offsets. We would invest in that company. We cannot invest in an oil and gas company because it is an extractive
I'm
industry.
talking about investing in the entity that buys the land and generates the credits. Okay.
Yeah, so we've seen several of those companies today, and have one that is, I would say, relatively advanced in our portfolio, and basically that's their model. They look for partners around the world that are interested in buying carbon credits. Then they buy land around the world, and the quality of the carbon credit and the amount of carbon sequestered varies based on the type of ecosystem that you're regenerating. So a rainforest is different than a forest, than a prairie. So we have seen those types of companies, and it is within the four themes that we invest in. That one falls within regeneration of ecosystems.
But there you've highlighted the risk, which is actually it's a very nascent market, and the quality of the credits is, I think, up for debate right now. Although there are third parties which claim to have standards, I think if you look at the media, the quality of these credits is very much a topic of furious debate, and so it's a topic of commercial uncertainty for you. But that's the sort of thing you would be willing to accept, that sort of risk tolerance.
Well, yes, but so there's a few caveats there. The first thing is that we as an investor can invest via debt or equity. So we have the possibility of coming in as a shareholder or coming in with a long-term credit. We traditionally prefer to come in with long-term credit. The rates at which it's mezzanine credit facilities. So on average, our credits are roughly 17 to 18% rate per annum. So it is, I would not say it's cheap debt, but given the risk of the companies, it is debt that allows us to sort of balance that risk return reward. Because we're mainly providing debt, we need companies to have certain traction and scale. So we don't invest in startups that are not already kind of like at a Series A. So these are companies that are that they roughly have somewhere between $500,000 and $3 million of revenue per year. And so because of that, there is something tangible that we can assess. So if it's a company that basically says, I'm going to buy land and create carbon credits, can you invest in me? But they don't have operations, only a business plan. That's very high risk for us. But if they're a company that's been operating for a few years, that is certified through, I would say gold standard is typically the certification that we like the most, that is already certified, that it already has a recurring business model with large AAA clients, which has demonstrated that they can actually execute on these types of projects and regenerate the land. So that's the profile of investment that we're looking for. It's a company that has traction and therefore can also take on credit and repay us over a 5-6 year period.
That's helpful. Thank you for clarifying how you evaluate it.
Thanks, Ram. And I'm gonna jump one slide, but I want to go now into talking more about the model and giving a few examples. And so this is sort of alluding to what I was saying right now. So this is kind of the risk return spectrum of investments, just traditional investing. And so at the bottom left, there's like philanthropy where there's no returns or even in some cases negative returns. Then you have traditional debt, then venture debt, which is mainly where we sit in as a venture debt fund. And then the right part is equity. We can do equity investments. We've done one, and the intention is to do maybe 2 or 3 out of the fund. But primarily, we're a venture debt investor that is looking for 17 to 20% returns per deal, depending on how we structured the facility, the amount of risk that we foresee in a particular company, the guarantees that they're giving or not, if we're coming in with a mezz structure. And so I would say that this compares fairly similarly to more traditional investments. If we compare ourselves with traditional mezzanine, they're typically around that 15 to 20% return. And so even though we're an impact first fund, given sort of the profile of company that we invest in terms of their scale and the types of credits that we're providing, we can be achieving at a consolidated portfolio level that 15% IRR.
So Alberto, just a question from Irvin in the audience, which is, how do you deal with currency risks? If your investors, are your investors all in local currency, or are they dollar denominated, and are they expecting the same returns on currency wherever you invest?
So this first fund is a Mexican peso denominated fund. The idea is that our next fund will be US dollar denominated. Right now, they are taking the currency risk. And they are aware of that currency risk and have been comfortable with taking that currency risks themselves. Going forward, what we basically anticipate once we have a US dollar denominated fund is that we will primarily provide our credits in US dollars, but if the company needs it to be in local currency, we will buy hedges on those credits, and the company will need to pay for them. So currently, a peso dollar hedge is roughly between 5 and 6% above the rate of the credit. So if you have a 15-17% rate, you're looking at a 20-22% Mexican peso rate. And so right now we don't take, I mean, we can provide funding in peso or US dollars, but our investors are the ones that for now are comfortable taking the FX risk.
Thank you.
Going back to this issue of portfolio construction, so here on the left axis, the vertical axis, we have financial returns, and then on the y-axis, and then on the horizontal x-axis, we have impact. And so some of these companies are already in our portfolio, others are hypothetical, but basically there are certain companies that have very deep impact. So Tamoa, which is the one that you see at the lower right end, that company is extremely deep impact. They're working with subsistence farmers that are harvesting corn and connecting them to the US market by helping them harvest heirloom corns and providing better incomes to farmers. So that's deep impact. But the financial returns on that company are more like 12% in US dollars, 17% in Mexican pesos, which is below sort of the hurdle that we're trying to reach at a portfolio level. But then we have companies that maybe the impact is not that deep. So going back to the pyramid, they might not be transforming the lives of poor people by helping them come out of poverty, but might be helping them improve their quality of life, like Dentista, which is it's a dental clinic. So access to healthcare doesn't get you out of poverty, but improves your quality of life. These companies are growing much faster. They have more attractive return expectations. And so we'll be doing some debt and even equity investments that might be yielding 20, 25, 30% IRRs. And then we'll build a portfolio of companies, some with lesser impact, although they have to have impact, some with deeper impact, but different return expectations. And then at a sort of average, we're going to be looking for a 15% IRR. And then now I'm just going to provide two examples of companies, and then I'll pause there and open it up to questions. So Salud Fácil is an investment that we did in 2021. They provide leasing facilities to peri-urban and rural health clinics around Mexico, so that these clinics can buy diagnostics equipment. And so these clinics are, very small clinics, normally run by a local doctor. Most people in rural parts of emerging markets do not have access to social health or to insurance. It's mainly out-of-pocket expenditures. And so they have very poor health access or healthcare access. And so by empowering these peri-urban and rural clinics, you are sort of strengthening the infrastructure of the type of organization that people in poverty can attend. And so therefore they can hopefully prevent diseases or diagnose diseases in a timely manner, so that people don't end up going into sort of life or death emergencies where a healthcare emergency is normally what sinks a middle-class poor family into deep poverty, because they end up, mortgaging their house to save their relative or whatever. And so if you're able to have stronger, better technology in these small clinics around emerging markets, hopefully they will be able to strengthen the capabilities and the access of poor people. For this company, we provided them a $750,000 5-year term loan at a 19% IRR. And then the final company that I wanted to share, it's a US company called Mina, based out of New York. And they basically work with artisans around all of Latin America, producing household textiles, pillows, rugs, blankets, carpets, and then they import them into the US and Europe and sell them via their own retail online channels. They sell them to wholesalers or sort of large retailers through wholesale, and then they sell it as trade to hotel chains. This company is roughly reaching $2 million of revenue today, and we provided a $500,000 growing amortization credit with a 17% return in US dollars.
We have another question from Somesh. Are there any restrictions on capital returns that US-based investors should be aware of? Any local US tax implications that should be factored in an investment decision into one of your funds?
I mean, that depends really on where the vehicle is domiciled. In our case, with this initial vehicle that we are operating today, which is domiciled in Mexico, there is a 15% local tax retention at the source on all capital gains. And so even for international investors, going forward, we expect to move to a Canadian LP that doesn't tax at the source, and basically the funds flow to the LP so that they need to file tax in their own domicile. But we started with the Mexico domicile because our anchor investors were Mexican, and that's the region that they wanted the fund to be domiciled in. But ultimately, we ended having about 40% of our LPs coming from either Europe or the US. And once again, most of our current investors are families or family offices. We do have a few institutional investors, but given sort of their commitment to impact, they are expecting the financial return, but they're a little bit more sort of concessionary with this fund in their expectations on return and on sort of legal tax structure, just because they see themselves as catalytic capital and want to help us develop this first fund. As we go forward, I think that will, and as we reach larger, more institutional investors, financial returns and legal tax structure will definitely become more of a and also FX hedging will become more of a relevant issue that we will need to take into account as we structure our vehicles.
So can you talk a little bit about going forward then? In particular, you've talked about Mexico, but what are your ambitions for Latin America? Can you say a few words about that, please?
So we can currently invest across all of Latin America. We don't, I mean, we're Mexican as a firm, and that's where most of the team today is based out of. But we have invested in companies across Latin America, or that have operations in different countries, not only in Mexico. Going forward, we anticipate raising a second fund sort of towards the end of next year, and are targeting probably like a $35 million fundraise with a much higher focus on other countries outside of Mexico, even though today we are already investing outside of Mexico. But the way in which we will achieve that is that we will have a second investment team based out of Colombia.
So just to that point, a question from Juan, which is outside of Mexico, what other Latin American countries would you, in your assessment, be a good target in terms of risk return? Because they're all very diverse, particularly with respect to restrictions, country restrictions on foreign exchange and so on. So maybe you could comment a little bit on that, please.
Yeah, and so, I mean, that's also why for a next fund, we anticipate structuring ourselves in Canada, in Ontario, because Ontario Canadian vehicles are the ones that have sort of more favorable tax regulations to invest across Latin America in specific countries, obviously. But I mean, I think the countries are more the usual suspects, and are, even though we say we invest across Latin America, I would say today most of our pipeline is Mexico, Colombia, Chile, Peru, and Brazil. I mean, those are really where most of the deals that we're looking at come from. We've randomly seen a few things from Central America or Ecuador or Argentina, but it's really marginal. And going forward, we anticipate our fund being primarily concentrated on Mexico, Central America, and the Andean region, which is Colombia, Peru, and Chile. Although we will have the flexibility to do stuff outside, we will more proactively target those countries, given that even though Brazil and Argentina have primarily Brazil have ton of opportunities, they're just a little bit too far removed from us, and would just be a little bit harder to manage.
That's helpful, thank you. Can I ask you to comment a little bit on navigating political risks from country to country? And also, it's my perception, maybe it's wrong, that the financial systems for capital in most of these countries is still yet to be developed to be mature. Would that be fair? Or, I mean, in some sense, I view you as being a little bit of a leader in going into at least financially immature region for capital for startups, or even beyond startups, because you were careful to say you don't take early stage, but you're taking companies which have some traction, but which may still need to have access to financing, where I perceive it that access to capital is not so readily available in many of these countries. Is that a fair assessment or not?
I mean, definitely emerging markets and Latin America are regions that are underdeveloped in terms of the depth of their capital markets. I would say, I mean, if you look at the history of private equity and venture capital and traditional, not impact, across Latin America. I mean, private equity funds, both global and local, have been around since the 80s, 90s maybe, and VC really took off in the last sort of decade, primarily in Brazil and Mexico, and traditional venture capital, and now, I mean, it's an immature but developing ecosystem, and most, if not all, of the countries that I mentioned as sort of the primary countries in which we're investing in, I would say, have relatively well-established rule of law, capital markets. Getting money out of the country is easy, and so I mean, political risk. I mean, there's definitely a tendency across Latin America towards leftist governments, but as of today, they haven't really changed a lot. Sort of the foreign direct investments and sort of ease of moving currency out of the countries. So I would say that from that perspective, I don't feel that we're taking as much risk, and maybe because I'm Latin American, I'm more comfortable with that risk. But as I said, 40% of our investors are foreign,
Right.
and they're feeling comfortable with that risk. And
Well,
I mean, the only other thing there is we are a debt investor, so
yes.
I would say that equity investments in emerging markets are definitely a much riskier strategy, because and in my 10 years of private equity, I didn't see a lot of exits. So getting out of public, sort of privately owned companies, exiting either to selling to another fund, to a strategic, or via an IPO, is not an easy task in emerging markets. And that is one of the reasons why we very consciously decided to come in with debt, that the company, and the return might not be that attractive, but the risk profile versus equity is limited.
Thank you. I want to just insert a couple of questions from the audience. First, related to your comment on rule of law, Karina just asked, do you have issues navigating state and private corruption in this region? You know, certainly I've known from Asia Pacific, in certain countries in Asia Pacific, that's been a concern, at least in my experience. What's been your experience with this geographic region here?
Yeah, I mean, certain countries in Latin America, and I would say Mexico being probably at the topper end of that list, are deeply corrupt, and not only corrupt, but have also very relevant issues with the drug trade. And so there's a lot of funds that are coming from illegitimate sources that are sort of filtered into the economy. We basically, the level and the depth of the due diligence that we do on each company is, I would say, extremely rigorous. Firstly, we do not invest in companies that sell to governments. So no kind of B2G business models. We stay away from everything that is related to being a contractor or providing any sort of product or service or partnership with local governments, because kind of at a sort of baseline level, that is where most of corruption is occurring. And there's also a huge risk as administrations change over time, that they just kind of close down the contract if you've been working with a certain political party and then it changes to another party. So we stay away from anything that is doing business with the government. And then in terms of additional due diligence, so we do site visits, we do background checks on the entrepreneurs, we interview management team, we come in, we have legal advisors that review all of sort of their corporate documents. They do like a in-depth legal tax due diligence on the companies. And so we try to mitigate sort of the the corruption, illegitimate business risk by doing a pretty in-depth diligence. And part of our background checks are also speaking with companies' customers, with company suppliers, with other shareholders, and in most cases, as we are an early stage investor, there are other investors in these companies, and so we're looking also for more institutional capital, either coming in alongside us or already being invested in the company. So, yeah, I mean, as you navigate these markets, I think you kind of develop a sixth sense in identifying where, due to the structure of the business model or the background of the entrepreneurs or the partners that they have, there might be some indication that there is something not legitimate or even not ethical happening.
Right. Thank you. And as we come to the final few minutes, I want to just clear a couple more questions. So Arun Matt asks, do you see a lot of sources of capital like you in Mexico, or are you just one of a few impact sources of capital for the companies that you're lending to?
Yeah, and I'll, as I answer that question, I also saw that Sheila Walker.
That's right.
So I'll kind of put both questions into both answers into the same question. I mean, it's definitely a growing ecosystem. I would say that, once again, Africa and certain parts of Asia have much more developed ecosystems today than Latin America. Just, I believe that given sort of the level of poverty or developmental needs that other parts of the world have above Latin America has just attracted more capital. So Latin America is a less developed impact ecosystem than other emerging markets in the world. There's also a perception that Latin America is for certain development banks, they believe that certain countries in Latin America are developed. And so because of that, there's also less access to funding from development banks for the region. But what is growing is local investors and local development banks putting funds into this ecosystem. I would say that in sort of the 5 or 6 countries that are more developed, which are Mexico, Colombia, Chile, Peru, Brazil, Argentina, there is, I don't want to say a healthy environment yet, but there's a handful, maybe some 10 local impact investors, and then maybe there's maybe like some 20 or 30 global impact investors that are operating across the whole region. So you've got firms like Acumen, you've got firms like Mercy Corp's Ventures, you have firms like GSV, which is an education venture capital firm. So COcapital is investing in fintech across the region with an impact lens. So there's definitely a pool of funds that are operating, that are growing, and there's activity in the sector, but there still needs to be more investors. Where there's definitely a dearth of capital is in the earlier stages. Like, there's very few investors that are coming in pre-seed, seed rounds. Tends to be angel investors. There's very limited funds, and so a lot of companies, even traditional startups, not impact focused startups, end up dying in those early rounds because they don't have the network to reach angel investors. And we currently don't anticipate investing outside of or moving into Asia or Africa. There is a possibility that we're exploring with a potential investor to invest in the US in a food systems, regenerative food system strategy, but that's still further down the pipe and might not occur until maybe the next year or so.
Alberto, the hour has flown by. You've really, you had a lot of questions coming through, and you fielded them all really well. We thank you so much for your time. It's been a really informative hour, and I certainly learned a lot more about impact investing. I thought your framework The slides you showed were incredibly educational in terms of giving context for what you do. So thank you again so much. We've recorded this and we'll be putting it out on our YouTube channel. Great presentation. And
Thank you.
Thank you all for joining us, and bye for now.
Thank you so much. Appreciate the questions and the time. It was a pleasure.
Bye.
Bye.